Hello, everybody, and welcome to Passing Notes podcast from Revolve Capital Group. I'm Bob Repass, joined again today with Chaz Guinn. Chaz, I wanted to start today talking about how the government can be a plus and not just a minus, but sometimes have really good programs that can help homeowners throughout difficulties. So, throughout your career, give us a little backstory as far as some of the government programs that you've worked with, and then I want to talk about some of the latest ones.
You know, coming out of the '08 Great Recession, there was absolute intervention, government intervention that came in a big way. And the Obama administration had administered a foreclosure moratorium nationwide. It only lasted for a particular time. But then you had this, TARP funds. Then you had this HHF, which stood for Hardest Hit Fund program that was now being developed. It had $7+ billion available to it that delinquent homeowners had access to tap into for government assistance on repayments for all the loans payments that they've missed over the months and years. The being able to have renovation dollars being tapped into. So you saw all these different programs. However, they felt hollow. We didn't see a lot of folks in our space actually allowing themselves to truly be able to tap into it, because there was all these different layers for investors and borrowers and even the servicer to even tap into it. There was all this red tape of, well, how do you actually fill out the application? Who fills out the application? Is it the borrower? Is it the servicer? So I say all that because we've seen some real meaningful progress in the government programs. I mean, to the point where we're starting to kind of see the ripple effects of these programs being put in place. But it's come a far way, dating back to 2009, 2010, to where you felt like these programs were put out there for headlines.
Right.
Versus actually.
Yeah, you mentioned the hardest hit funds, right? Well-intentioned, right? The implementation was another story, right? The federal government allocated money, but it all went to the states. And some states were better than others at getting it, downstream
and allocated
to the borrowers. Mm-hmm. And one thing at that point in time was the borrower had to take the initiative to apply for the funds without the help of the loan servicer or the investor, lender. They were on their own. And it was a mountain of paperwork, and a lot of them just threw up their hands and said, I can't do it.
Bob, my issue that I had with that is the borrower already had a behavior of not making their payment. So now you're asking them to fill out more paperwork and go online and send and mail in order. They're not even making the payment, John.
Right. And most of these people had a no income, no verified loan anyway.
You,
so
right?
They didn't even turn the paperwork in to get the loan.
Thank you.
So
it was a heartbeat, quick blood sample. You got the loan, exactly. Off and away you go.
Exactly.
And this is where we felt like there was a little bit of a shuffle game. The homeowner didn't know the proper method to apply and get the funds. The servicer didn't know if a delinquent homeowner was actually going to follow through. It was the chicken and the egg that it felt like. And this is why I mentioned that, these programs felt hollow, right? Versus to where I think we're starting to see the programs evolving to where they're actually able to help real folks that have been, affected by COVID. That was a real deal. Millions of jobs were lost. And sure, millions of jobs since then have been gained. But in certain sectors, they have not. They've been decimated. Certain restaurants and family businesses that have been around for 30 plus years that got really taken out by the COVID crash haven't recovered. Right. So, however, they were been in their house for 25 years, Bob. Right. They're the ones that took it over maybe from grandma and put a new roof on it. So this is where we're starting to see good things happening in the programs, right? Helping folks.
Yeah, the post-COVID program, the housing assistance funds, they did learn from the past mistakes. The federal government still allocated it down to the state, but they allow the servicer to work with the borrower in applying for those funds, right? Kind of a hand-holding kind of thing. So the borrower would contact the servicer saying, I need help. And the states are there to provide funds. And Chaz, they will make all the past due delinquent payments, past due taxes. They will get your account current, bring it up, reinstate the account. You have to fill out an application, but it's not like going to the moon. And we have seen real examples of it working. So I thought what we do today is kind of talk through, not just theoretically, but actual case study of a deal that we've had on an asset. And I'm going to let you tee it up, being a former Californian, right? Because this property was in Foresthill, California, which may not be familiar to everybody. So kind of walk us through a little bit of the backstory on the asset.
This small mountain town of Foresthill, but it did fit the criteria that we ask for from large sellers anyhow, is from a criteria box of home value: 3-bedroom, 2-bath, 2,000 to 2,500 feet. Call that the median, right? So there's going to be stuff that kind of tips on the right side of the bell curve there, and then also lower valued assets than on the left side of that bell curve. However, if you look at the area, it's starting to really feel like, folks that have been kind of flighting out of California, you could tell this area was one that was actually affected by it. However, you look at the property value, you understand that these homeowners had already been in this house for decades. They had invested years of not only loan payments, but actual rehab to the home. And the last thing they wanted to do was to lose the property. And COVID affected them. And they had an inability to really kind of get back on track, in an expeditious fashion, which then caused them to be not only 3 months behind, but then 9 months behind, and then 15 months behind. And now what starts to happen is a wound that started out like this becomes gaping and really gashing. And now you're saying, well, how do we fix this? How do we tap into an ability to fix this? So, up on your screen now here, you're seeing a $580,000 house. You're seeing that they had a UPB. So they had actually taken the loan balance down to almost half, $267,000. But the past delinquent payments has caused their legal balance, their total payoff balance, to balloon to $360,000.
But they still have plenty of equity.
Still sitting on equity.
Right. $360,000 total debt on a $580,000 property. Right. So when we bought this loan in January of 24, right, they were due for May 1st of 2021.
So they're coming up on three and a half years, 3+
right.
years, right?
Exactly. So they took the initiative to contact the servicer and work with the servicer through the state of California Housing Assistance Fund for the funds to reinstate their loan. They were able to work with the state and the servicer to receive a check to apply to their loan for $79,999.73.
And how many payments was that?
That was 35 payments. They brought the account current. It is now due for April 1st. We received that reinstatement check on March 5th of 2024. So basically 60 days after we bought that, we got a full reinstatement of just under $80,000. And it reduced, just to give you an example, if you look at these numbers here, it reduced the unpaid principal balance from $267,000 to $250,000. So only a $17,000 principal reduction because they owe so much accrued interest on those past due payments and other fees and charges that were reimbursed. So the state made them whole. Now, moving forward, it's up to them to keep those payments going, right? They have a lifeline from the Housing Assistance Fund, and now they're due for April, and they should be clean slate and ready to roll.
Multiple incentives I just heard. I want to keep my house. I'm behind in 30+ payments. I need to be able to catch up. I think many folks that are listening think that these programs only apply to those that have just recently defaulted, have just gone down 3, 4, 6, 7, 8 months behind, and think that those are the programs that apply just to them. Sure, but it's not only to them. These borrowers had been behind 35 months and had completely gotten brought current. So not only were they able to save their house, but also to retain their equity in the home. Because we all know that given the years of delinquency, they could have stuck a for sale sign in the yard, paid us off, been able to take that equity and potentially rent. But as we all have seen, look at the supply. What are we at? 2.5 months now of supply that's available. So, when something goes up for sale today, it's being snapped. Even in today's tough financing market, you're starting to still see that folks are fighting for not only the home, but their well-being of keeping the equity that they've built in the asset.
Well, right. And you mentioned they also been in there for nearly 20 years. So they have what we call emotional equity, right? They've basically blood, sweat, and tears into that property. I believe this house is on like 20 acres in that town, right? So, I mean, that's their homestead. They didn't want to lose it. And they took the initiative to apply for the funds, brought the account current, and now have a clear path to move forward. And you mentioned 35 payments. Remember, this was a post-COVID plan. They were due for 2021. So if you were delinquent, because of COVID,
Sure.
you can apply for these funds, whether you're due for 2021, 22, 23. You might only be 6 months. You may be 3.5, 4 years.
What I find ironic, though, is that these folks took advantage of a program readily available statewide, nationwide, and however, only a fraction of the folks are even tapping into it. That's issue number one. Issue number two is we started to see this trend show up in the data around 2017, 2018. However, it was only about 2 loans out of every 10 that we started seeing sitting in an equitable position, $500,000 home, $300,000 loan balance, that were sitting delinquent 1, 2, and 3 years. Odd. It almost felt like it was just kind of an anomaly, a unicorn in that specific data set. However, as you started to progress towards COVID, you started to see it creep up to 3 out of every 10, 4 out of every 10. We started to get into 21 and 22. It started to become 5 out of every 10. You and I, before we looked at this data, it's at around 6 to 7 loans today out of every 10 are sitting in an equitable position and delinquent.
Right.
That didn't happen 15 plus years ago when folks were sitting underwater, heavily delinquent, because they're like, why am I paying an investment that I owe more on than it's worth? And now people are seeing the inverse happen, where they're sitting on real meaningful equity, but still not making the payment.
Right. And a lot of them are not even applying for these housing assistance funds. I asked you on a previous episode, give me one word, that's a top concern. And your word was awareness. And in this case, the borrowers a lot of times aren't aware that they can apply for these funds. And what we do in an oversight position of our loan servicer is to make sure that they are communicating to the borrower, have you applied for housing assistance fund? So we need to make the servicer aware sometimes, because it's not top of mind to them. And various states have various amounts of money left. Some have spent all of it, and a lot of them haven't spent very much of it. Right. So they have to be able to work with their servicer and find out how. It's real easy. Most states have a website you can go to and apply for these funds.
Sure.
And, it's not like it was when we were talking earlier on Hardest Hits, where it was a mountain of paperwork. It's like a 3-page application, basically like you're applying for a new loan. You just tell your story and your hardship.
This is why I love this test case, is because this is a real deal here in 24, where we acquired an asset in January. We got the funds 60 days later. They've now brought current. It's a win-win situation for both investor and homeowner. This is the types of scenarios we want to ensure that we push. And this is why we're very aggressive right now with our servicers to be tapping into every delinquent homeowner that is sitting on our books today, to make sure they're tapping into these programs to get themselves caught back up, especially if they have the economical means to stay and pay. Not everybody fits into that boat, right? COVID actually took down your economic situation and you haven't recovered. Well, then you need to sell. Right. You need to be able to tap into your equity and go do something else, so home ownership in the future is a reality for you.
Absolutely. That's a great point. All right. So housing assistance funds and getting reperforming loans, getting that cash flow back into our pockets as it continues to go, keeping that homeowner in the property, right? Keeping them engaged. And we rely a lot on our third-party servicer to do that. So we want to take time today just to kind of focus in on a real-life example of how somebody can benefit from one of the government programs and how it can impact us as investors, right? And allow us 60 days later to get a big return of capital back on an asset that we bought. So, Chaz, I think it was great that we talked about it. I hope folks will like and subscribe to the Passing Notes podcast. Give us a little words of wisdom as we wind down.
we're sitting in a weird time here in 24 as we head into an election year, right? It's all going to be wonky. We're seeing rates still unchanged. All right, everybody's trying to play predictor of what's going to happen in the Fed. I think that should have little play out of how you invest and how you look at different markets, especially in the private equity market. This market has been hedging against macro issues since the beginning of time. And here we are sitting in a time that's uncertain for a lot of different businesses. Look at the commercial space. Look at the multifamily space, especially if you're in real estate. So listening to this is a way for you not only to be a passive investor, but also an active one, and ones that are being able to pick up today's real estate assets wherever they're located, from New York to San Diego, from Seattle to Miami. In all 50 states, you're going to be able to acquire assets at a discount when supply is scarce. So I think when you're talking about words of wisdom, for us, this is where we're getting really excited, and not only the different product sets we're seeing come to market, but the discounts in relation to market values that we're seeing as well. So, for the football terms, it's scoop and score time.
Absolutely. So again, you mentioned passive and active investors. So if you're an active investor and you want to look at buying assets like the one in Foresthill, California, just email tradedesk@revolvecapital.com. and you'll be on our list to receive offerings. And if you're more of a passive and have capital you're looking to deploy, go to our website, revolvecapital.com, and check out how you can be part of our capital funds that we have available to accredited investors. Chaz, as always, it's great to share this time with you, and I think today we delivered some quality content to our listeners.
Same. Cheers, Bob.
Bye.